Back to the Tanner Realty Group podcast. My name is Austin Cassity. I'm here with Mike Tanner, and we are going to be talking about how affordability for buyers in today's market is affecting the market and whether everything that's happening in the market is fear driven or is it numbers driven. Mike, how are you doing today?
I am well, thank you. And this is a fantastic topic because if you look at every major media news source, it is all completely doom and gloom. And there are some opportunities out there in different markets. And so I'm glad we're talking about this today.
Yeah, so why don't we jump right into it? Long story short, I think that today's market is being shifted due to the numbers, not just fear. Yes, fear plays a factor into it. However, when you look at the numbers, you can actually see why the market is shifting in favor of the buyers. Maybe prices are starting to soften in your area. And we have the research and the numbers to back that assumption there. So, here in Washington, in Clark County, where we service most of Washington here, we have something called the Housing Affordability Index that was researched by the University of Washington. And looking at the stats here from 2017 all the way until 2021 and then current quarter two of 2022, we don't have the numbers yet for Q3 of 2022, but we have an affordability index of over 100. Well, what does that mean? So an affordability index shows that if it is at 100, that is saying that 25% of the median household income is being spent on the mortgage of principal and interest. And the housing and even NAR looks at affordability as 25% of household income being going towards mortgage principal and interest. So since 2017 to 2021, we have seen that number actually above 100, meaning that it's less than 25% of the median household income to be buying a home. What we saw here recently, though, since the end of since 2021, it's been trending down a little bit, and then 2022, we see a steep decline. And that's when the Fed started raising interest rates. I'm sure you've heard that mortgage rates have started to go up. And from just quarter over quarter, we have seen a huge decline. Q2 of 2021, we were at 109.6 in Clark County. And at the end of quarter two, 2022, we are at 63.3. That's a 46.3 point difference. That is huge in terms of affordability.
I think decline is a nice word. It fell off a freaking cliff is what it did.
Yeah, so what that's saying is that the median household income is not matching the affordability of housing right now with these high interest rates. Yeah, prices may be coming down great, but they need to go down a lot with these higher interest rates. You have to think that the interest is being accumulated for 30 years. That is a long time and can make a big effect on monthly payment and annual payments as well. You may not be building up equity as fast through debt pay down. So just based on that index alone, well, we can start to make assumptions or make inferences about our market saying, well, why are prices softening? Why is my house sitting on the market longer than it was 2 years ago or a year ago when the housing market was red hot? Well, it's because buyers can't necessarily afford it right now. We have to think the
There's always two parts to
median
that,
housing
right?
income, the median housing income can't afford the median house price right now.
Yep,
So
absolutely.
um, just looking at that number, that's why our market's going in the direction it is right now, shifting towards a more neutral or buyer's market. Mike, what are you seeing right now in your markets? I just touched on Washington. Let's talk a little bit about Oregon and Oklahoma as well.
Well, it's a national issue. The numbers may not line up exactly, but in every single market, as you've alluded to already, Austin, there's two parts to every single affordability index. There's the interest rate and there's the pricing, right? And if one of those is out of whack, it's going to impact your affordability index. So prices are going to soften a bit so people can actually afford the interest rate and get into a house. Now, we've also seen people in all the markets we serve, Washington, Oregon, Oklahoma, they've talked about, well, I rent, so this really doesn't impact me too much. Oh, yes, it does. It impacts you in a big way because if your property owner that you're leasing from has a mortgage on their property, which, by the way, the vast majority do, or if it's a new investor that comes in, you're even going to get this more, they've got to cover that payment. And so your rent is going to go up. I've never understood the folks that say, oh, it's not going to impact me. I rent. Well, everybody has to live somewhere. And odds are somebody's paying a bill for you to live somewhere. And so if they're paying that mortgage, they're going to see that go up. If they're paying on their property and you're renting from that person, it's going to go up as well. And so buying a house still probably is the best idea based upon your situation. However, you need to understand that this impacts all of us, not just property owners. It impacts absolutely everybody.
Yeah, absolutely. And to have affordability at a 3-decade low just from Q2, well, Q3 alone, we've seen interest rates go up over probably 1 to 2% from where they were at the end of Q2. So uh, there's still a little bit more pain to come here. And well, housing doesn't shift as quick as, say, a stock market or anything like that. We may not see a 2008 crash, but what we're seeing right now is a softening of the market, a
Mhm.
decline in prices to help match that affordability.
Well, and I don't
So,
think we're going to see, I really don't think we're going to see a crash, Austin. I really don't, for a couple of reasons. Number one, um, before the crash in '08, '09, all the mortgage-backed securities were in trouble. I mean, they packaged up really horrible securities with some very good securities, and it just was not a secure investment. There's a ton of government oversight now to make sure that doesn't happen anymore. And the second thing, because house prices have gone up so dramatically in the last, say, 5 years, even before that, but let's just talk about the last 5 years, there is so much equity in people's houses right now that you're not going to have the same issue that we had back in '08, where the equity was, that margin was a lot more thin. Now, people still had some equity in their house, but not like now. I mean, if you've been in your house for 20 years, holy smokes, look at what happened in the last 5 years that you've owned that house. You're, I mean, you've got tons of money in that place. Even though it may have come down a little bit and depreciated off the peak, you've still got loads of cash in that house, or equity, excuse me, to be able to do something with. And so that's why I don't think we're going to see the foreclosures. I don't think we're going to see a crash. There's just too much still supporting this, even though the interest rates are wacky right now.
yeah, I agree. And one thing we are seeing in today's market, some numbers came out a few weeks ago showing that new home sales were actually up quarter over
Hmm.
quarter. And but resale homes or homes that are used per se, were down. So do you want to kind of touch on that and why that might be?
Sure. It's the simple reason that builders are smart. They need to blow out their inventory, and we're seeing a lot more builder incentive rates for interest rates than we have before. Because typically you could come in with your own lender and the rate was still good based on even what the builder could offer, or the builder would go with different banks and arrange those business type arrangements. Now you're seeing builders get very aggressive about their interest incentives because they want to get rid of their inventory as best they can. They don't want to hold on to it because if you have somebody that's paying almost 7% for a loan, they can afford a lot less of a house. Well, if a builder comes along that does a buyer incentive interest rate for using their preferred lender, you can get in at a lot less expensive monthly payment than you could just by going with a regular retail type lender. That always hasn't been the case. It is now.
Yeah, and we have one of those closing here this week as well, where they got in well under market interest rate, and they're
Yeah.
saving hundreds and hundreds of dollars per month on
Yeah.
their interest rate, saving them thousands over the life of the loan. So definitely can see why that affordability plays a factor in not only home sales, home prices, but also what builders are doing and what incentives a builder's a seller, what incentives sellers are offering their
Yeah.
buyers. So, Mike, what about investors right now? Yes, interest rates are high. How should investors start looking at this market? Obviously, there's opportunity in every market.
Yeah.
Who's going to come out ahead here?
The old saying, cash is king, is very true right now. It's always going to be true, but especially right now. If you're a cash investor and you've got money sitting on the sidelines, now is the time because you can get a deal. You can close it quick. Rents are obviously up. You can get a really good ROI on your money right now because you've accumulated cash. And so if you have money on the sidelines, you really want to look at getting that into play right now in the real estate market because we are seeing a lot of price reductions. We're seeing a lot less competition for all types of properties right now, including commercial and including multifamily. And so that's where investors normally like to go. So if you have been waiting for your time, this is it. This is it. And if you've got enough that you can maybe afford a smaller mortgage, maybe not pay cash for the whole thing, but leverage somebody else's money, a little bit less, more expensive interest rate right now. But if you can maybe do a hybrid plan, you don't have the full amount of cash, it's still potentially a good opportunity as well to put your money to work for you.
Yeah, definitely putting that money to work. People that may have equity in their homes that you were talking about over the past 5 years. Well, interest rates are so high, I don't want to sell my house, but I want to tap into that equity. There's options for them as well to start buying investment properties and start building their wealth through real estate.
Yeah.
Definitely now you need to have a longer time horizon, and who knows what's going to happen 6 months, a year, 5 years from now, but 10 years and longer history shows that most likely going to be all right. So,
Yeah.
um, thanks for touching on that. And that's kind of all we have today. Affordability is makes a huge impact on our real estate market. And if you have questions about how affordability may play into your specific circumstance, feel free to give us a call, shoot us an email. We'd be more than happy to get you in contact with someone who can break down the financials with you, and we can help you find either that next home or figure out what you can do with the equity in your home. So, Mike, thanks for joining us, and excited to see where this market goes.
Absolutely, me too. And it's fun to help clients that don't think that they can do something right now with the affordability being a little weird. And you referenced our clients this week that are getting into a place with that builder incentive. Nothing makes you and I happier than to help people get into a place when they think they can't do it. It's a lot of fun to watch.
Yeah, definitely. All right. Well, have a great week. We'll be back here soon, bringing you more information. Bye bye.
Talk to you later.